The stock market, it can feel pretty intimidating, right? It's this whole world filled with jargon and crazy-looking charts that seems, I don't know, almost impossible to break into. Well, we're going to change all that. In the next few minutes, we're going to break it all down and give you a clear, simple roadmap to get started.
So here's our game plan. First, we'll pull back the curtain on what the stock market actually is. Then we'll figure out how you get in the door, the partner you need to start investing. After that, we'll explore the two main philosophies that guide basically every investor's decisions. And finally, we'll get super practical and walk through placing your very first order. By the end, you'll have the complete playbook.
All right, let's kick things off at square one. What exactly are we even talking about when we say the stock market?
It might feel like this huge, abstract cloud of numbers floating around, but the core idea is actually surprisingly simple. And here's the key. When you hear people say they're investing in the market, they're not buying a piece of some big, vague concept.
No. Instead, you're buying a piece of an actual company. Think about it that way. Every time you buy a stock or a share, you literally become a part owner of that business. You're entitled to a tiny slice of its assets and, hopefully, its future profits.
So, where does all this buying and selling happen? Well, that's where exchanges come in. You've probably heard of the big ones, like the New York Stock Exchange or the NASDAQ. Just think of them as giant marketplaces that bring all the buyers and sellers together, keeping track of the price of every stock based on plain old supply and demand.
Okay, so you get it. You're buying shares of companies on an exchange. Simple enough. But you can't just stroll onto the floor of the New York Stock Exchange and start yelling out orders, right? So how do you actually get in on the action? Well, you need a partner. And that partner is called a broker. These days, it's pretty much always an online platform or just an app on your phone. They're your connection to the market. You tell them what you want to buy or sell, and they go and make it happen on the exchange for you.
But here's the thing. Not all brokers are created equal. As you're shopping around, here's what you really need to look for. Keep an eye on costs, for sure. But also, is the platform actually easy to use? Do they give you good research tools? And, trust me on this, don't overlook customer support. It's a lifesaver when you're just starting out.
And what's really amazing for us as new investors is just how competitive this has all gotten. I mean, look at this. The big players, Fidelity, E-Trade, Robinhood, they've all dropped their account minimums to zero, and they offer commission-free stock trading. The choice really just comes down to what you're looking for. Maybe it's Fidelity's powerful tools, E-Trade's slick mobile app, or Robinhood's easy access to crypto.
All right, so you've picked your broker, you've funded your account, you're ready to go. But now comes the big question. What on earth do you buy? This is where research comes in, and generally, investors fall into one of two major camps.
The first approach is called fundamental analysis. And I want you to think of this like you're a detective. You're digging deep into a company's financial health, you're reading their earnings reports, looking at their debt, checking out the broader economy, all to figure out what the business is truly worth. It's all about the long-term value.
Now, the other side of the coin is technical analysis. This is less about being a detective and more about being a pattern spotter. With this method, you're not really looking at the company's books, you're looking at its stock chart. The idea here is that all the important information is already baked into the price, so you just analyze past price movements to try and predict what's going to happen next. It's really popular for shorter-term trading.
So if you want a super simple way to remember the difference, it's this. Fundamental analysis helps you answer the question, what should I buy? It's about finding a great company. Technical analysis tries to answer the question, when should I buy? It's all about timing.
And you know who's a huge fan of fundamental analysis? The one and only Warren Buffett. He put it perfectly. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. See, his whole philosophy is about the quality of the business, not trying to perfectly time the market's zigs and zags.
Okay, let's get down to brass tacks. You've done your research, you've picked a stock, now what? How do you actually buy it? Well, when you go to your broker's app, you don't just hit a big button that says buy. You have to choose something called an order type. Let's look at the main ones.
First up, the limit order. This one is all about control. Let's say a stock is trading at 50 bucks, but you think that's a little high. You only want to pay 49. Well, you can set a buy limit order for $49, and your order will just sit there. And it will only go through if the price actually drops to $49 or even lower. You get to name your price.
So what's the catch? Well, there's always a trade-off, right? The big pro is you have complete control. You will never pay more than the price you set. The con? Your order might never get filled. If the stock suddenly takes off and never comes back down to your price, well, you're left on the sidelines. Next up, we have the stop order, or as most people call it, a stop loss. And that name tells you everything you need to know. This is your safety net. It's all about managing your risk. You place it below the current price of a stock you own, and if the stock starts to fall and hits your stop price, it automatically triggers an order to sell. It's designed to get you out before things get worse.
Now, here's the really important part you have to understand about stop orders. Once that stop price is hit, it becomes what's called a market order, which just means sell it now at the next available price. In a really volatile market that's dropping fast, that price could be a lot lower than your stop price. It's a protection mechanism for sure, but it's not a price guarantee.
So when you look at this table, it all boils down to one simple question. What's more important to you on this specific trade? With a limit order, you're prioritizing the price. With a stop order, you're prioritizing getting out. You're choosing certainty of execution over certainty of price.
All right, we have covered a ton of ground, from the absolute basics to the nitty-gritty tools of the trade. So let's pull it all together into a simple playbook that you can take with you.
Just remember these 5 core ideas. 1, you're not trading symbols, you're buying pieces of actual businesses. 2, you need an online broker to be your gateway. 3 and 4, you've got 2 main ways to think about your research: long-term value or short-term trends. And 5, you have powerful tools like limit and stop orders to manage exactly how you buy and sell. So look, we've given you the map, we've given you the gear, and we've walked you through the playbook. The stock market isn't some secret, impenetrable club anymore. It's a marketplace with rules, with tools, and with strategies that you can now understand. The next step? Well, that one's up to you.